Very pleased to welcome back to the show Greg Weldon. I mean, this guy is I always say Greg is the best introduction I can give for Greg is this is the guy that other analysts read to find out what's really going on. You hear a number, a headline news number. Well, I promise, Greg's gone 19 layers below that to figure out what's really going on, an international scope as well as domestic scope. Greg, welcome back to the show. Thank you for taking the time.
My pleasure, Michael. Thank you.
And I also say, you would never have heard this, Greg. I said, I wish I had your speaking voice. I myself sound like Mike Tyson's son, and then we bring an adult on like you.
Thank you.
Let's start with the big picture stuff here, and I'm just going to throw some things at you. Obviously, when people go to weldononline.com, they get much more, whether looking at Weldon Live or the Trend Tracker. You've got managed accounts, that kind of stuff. But let me just throw things. We talked just a moment ago about, to Victor Adair and to Rob Levy about that OPEC meeting. It did have an impact on oil prices. What did you make of it?
Well, I think there's two key takeaways. The first one is bigger picture, and that would be Saudi Arabia, their domestic economic situation, the fiscal austerity that they announced actually before the meeting, which in my mind totally set up this deal. The Saudis are pretty desperate. I mean, it's almost as if they kind of declared war on U.S. frackers and are losing that war. Their domestic situation, they're cutting salaries of government workers. I mean, it's pretty severe in terms of their budget situation, number one. Number two, the fact that they're willing to deal alone is significant. So that's the bigger picture issue, which I think is very positive, potentially longer term. I think in the short term, however, the fact that they're cutting 350,000 barrels and Iran is going to be allowed to continue to increase production. They're at 3.6 million barrels a day. Their goal is to get to 4. That would instantaneously, and it won't happen instantaneously, but if they were to reach their goal, that would wipe out what the Saudis are cutting. So that's kind of a negative in the sense that this is not that big a deal, quote unquote deal. But on the other hand, the fact that Saudi Arabia is willing to cut production and allow Iran to continue to ramp up because of their own domestic situation in the House of Saud is really interesting to me, and I think that's more bullish longer term than the negatives.
Let's switch over to, we talked just a touch earlier about the U.S. presidential event. Let's start with number one. Do you look at that as an important variable in the markets? Two, you see all this focus on the debates. You got 2 more to come, so should that be sort of a notice of a little more chaos in the markets or at least volatility there? Can you give us your perspective on that?
I would say yes and yes. I think, clearly it's going to be important. There's winners and losers on both sides of the equation. The thing that does worry me a little bit about Donald Trump being a kind of a conservative libertarian is his stance on foreign trade. I mean, protectionism is potentially the worst thing we could pursue right now. So it'll be interesting to see, if he does get elected, how severe he might be in pursuing some of these deals he's talking about, and just in terms of getting countries to pay for their own defense and stuff like that. Obviously, Hillary Clinton has negatives in terms of, some of the healthcare business and in general, capitalism in general. I think it's interesting to watch one currency cross that can tell you kind of to some degree how the market at least is perceiving this, and that is the Russian ruble against the Mexican peso. Peso down when Trump is doing well, Russian ruble up when Trump is doing well. So from that perspective, the peso rallied this week, and although the ruble got hit off the debate, it actually rallied too on the back of the oil deal. And frankly, if you look at some of the oil-producing countries, Norwegian krone broke out this week, Russian ruble broke out this week, even something as peripheral as the Indonesian rupiah broke out this week. So I think that that's interesting to me in terms of kind of supporting the thought process around this was a positive week for the energy sector. I try not to get too involved in politics. What I can say to you, Michael, from my heart, it is somewhat embarrassing to watch that debate, knowing that these are the 2 best candidates that our country can put forth to our people. I mean, seriously.
Yeah, I've been on that theme for, since they both got the nomination, but when they were the presumptive nominees, I said, a country of 340 million people, and this is what the democracy has come as that's the choice. I do think that's the bigger story, and I think it has macro long-term macroeconomic implications, financial implications, because you're talking about two people who come into power with the highest disapproval rating in history. This is going to further divide the nation, whichever one it is, and further erode confidence in government. So, yeah, I think that's a big story. Greg, let me just reiterate. So you're saying if Trump isn't doing well, the peso goes up, but are you also...
Peso goes down. I'm sorry, dollar peso goes up. Peso goes down when Trump is doing well, and the ruble goes up when Trump is doing well.
Okay, there you go. Wow. Okay, let's shift. Let's keep going here. I mean, the other big focus has always been the Federal Reserve. We look at the will she, won't they. They're not going to raise interest rates. Obviously, now in September they didn't, but now we're looking at December. Again, let's start with two things. How significant would it be if they did raise in December? It looks like every time it looks like they might, the market doesn't like that too much. But again, do you suspect that that would be a longer term kind of flow through into the markets?
I have to say this could be one of the most difficult positions outside of being in a crisis that the Fed will face here. They kind of have a conundrum ahead of them. If they are truly data dependent when it comes to the macroeconomy, when it comes to final demand, when it comes to manufacturing, when it comes to jobs, when it comes to all the things they talk about, there's no way they would be hiking rates here. On the other hand, you have a situation mathematically based on the calendar, as simple as that, where inflation is going to rise if oil just stays where it is, let alone if it rallies from here. Take this, for example. Gasoline prices at the wholesale level in the futures market bottomed last year in February below $1. They're $1.40 now. That means come February, you have a 40% year-over-year increase in the price of gasoline. You're going to see that across the board in the energy sector, and that's going to influence the inflation data significantly, because headline inflation and core inflation are two different pictures. And if headline inflation catches up to core inflation, which it likely will, you will have achieved the Fed's goal. And from that perspective, they should be hiking rates. Not only that, but if they don't hike, that would tend to bring the dollar down, which would lift energy prices and make it even more, potentially tricky going out further. So, it's, to my mind, it's kind of 50-50. I think there's a really good case to be made that they should not hike rates. And if they wanted to say, hey, we see this rise in inflation coming, but it's calendar-based. It's not to the sense that consumers are paying more for gasoline in December than they were in September. That won't be true. So it really is tricky. It's 50-50, but the futures market is only attaching about a 38% chance that they'll move. So odds are they're not going to hike rates, according to the market.
Well, I look at some of the economic indicators, and I think it's fair to say that we're not talking about a robust economy in the States. Are we talking about a C or a C plus kind of thing? And yeah, you can compare it to what's going on in Europe, and that looks awfully good. It's better than what's going on in Canada. But and I'm just wondering to the degree that the Feds must now keep an eye on what's going on internationally. I mean, if they raise rates, I think that's just a big check mark for a lower Canadian dollar, lower euro, that kind of stuff against, at the very least.
Absolutely. And in the case of Canada, you bring up a good point, because we just had a slew of data, which outside of the trade data, which was export-based and mostly commodities and autos, when you saw the retail sales, it's 3 months in a row that it's below expectations, and 2 months in a row where retail sales fell when they were expected to rise. Throw in inflation, where CPI was much lower than expected. The Bank of Canada is in play for sure. And I think we spoke about this last time too, that they are expanding their balance sheet almost in a stealth way significantly right now. So, and you also have the fact that you have dollar LIBOR rates rising, and you got some regulatory changes that are driving that, but you also have the Fed, whereas, Canadian LIBOR, Canadian dollar deposit rates are pretty much staying where they are, to the degree that they're now below the U.S. rates for the first time in a while. So the Canadian dollar flirted with a big breakdown this week and then kind of rallied back on the oil deal. But I think the Canadian dollar is very, very vulnerable here. We talked about that last time, and I stick with that call.
Greg Weldon is my guest. You can find him at Weldon Online, WELDON, weldononline.com. As I say, this is the analyst that other analysts read on a regular basis, and certainly we're very lucky to have him with us on the show. But I've got to come back and talk about an area that he's done extremely well in, and that's, of course, identifying the lows in gold and silver. I want to ask him about that when we come back on the Money Talks Network. Coming up, I'll be talking about your tax dollars and the Goofy Award. Plus, I've got 3 different shocking stats of the week. All of that coming your way. But right now, very pleased to have with me Greg Weldon. Find him at Weldon Online, weldononline.com. Greg, let me just get you to reiterate something there. If you're looking around for currency exposure, obviously, if we're Canadian, you're saying you've got to have some of that U.S. exposure. Is that pretty much across the board? It's sort of U.S. dollar first?
Not necessarily. I have to say, frankly, and it's a little tricky here to kind of suggest why this is happening, but some of the European currencies actually look pretty good here. Stuff like the Hungarian forint, the Polish zloty. There's a couple of them. Norway's also benefiting from the crude oil situation. And even the euro, to me, doesn't really look that bad. And you would think, given what's going on in the banks over there, and given that their stock markets have underperformed, given that you still have problems with the data that's just come out from Spain and Italy, Spanish budget numbers were not good. It is kind of difficult to figure out why, but then you say to yourself, well, if the U.S. is potentially going to raise rates, the U.S. bond market kind of loses its flight to safety label, and all of a sudden the German Bund becomes the flight to safety. And from that perspective, I think you've actually seen some demand for euro created by a potential crisis in European banks. Mm-hmm. So that may be a stretch. I'm not sure. I really can't quite put my finger on it yet. But the dollar to me is sideways. And right now the dollar, I think the Fed is happy to have the dollar sideways. They don't want it to go up because that would be damaging to commodities and emerging markets, and you might bring back into play the international risk that they talked about just a couple of months ago. And from the perspective of meeting their inflation goals, that wouldn't be positive. But they also don't necessarily want the dollar to go down too much here either, because then that could lift energy prices and put them in more of a sticky situation down the road as it relates to just the calendar effect on CPI. So I'm looking at kind of some of the peripheral currencies, stuff that might have once been called exotic currencies, and even to the degree that I think you could just simply be playing the Russian ruble and the Norwegian krone here. Even the Brazilian real doesn't look too bad. The Indonesian rupiah, like I said before. So no, I'm not really focused on the dollar because I don't see a big trade there. I might play maybe a great cross idea would be to be long the Norwegian krone against the Canadian dollar. I'm kind of insulated from the oil impact there as well.
Interesting. Like, I can't let you go without talking about gold, though. I mean, you've done very well in the gold market over the last, I guess it's nearly 9 months now. Whether it's in stocks or whether it's in the metal. Excuse me, Greg. Just get your perspective on gold at this point.
Yeah, we've done quite well in the gold. That was a good call at the beginning of the year for sure. More recently, as you know, we got a little more cautious, thinking there was a correction coming. You got kind of a correction. You actually had a correction to the upside in the gold-silver ratio, which was interesting. But what that meant was that gold did not meet its downside targets. The first Fibonacci retracement, for example, is 1250. You really didn't even get close to that, whereas silver actually hit its first downside target. And I would add, very important too, that the CFTC Commitment of Traders report continues to show excessive bullishness in terms of speculative positions in both gold and silver. And I would throw in as a little added bonus, what looks really much more solid to me in terms of the whole setup is some of the industrial metals here. Tin, always a leader, up and down, is leading to the upside. It's had a really nice rally, long-term breakouts taking place there. You also have aluminum, you also have lead, and you also have nickel kind of pulling up the rear here. And the DBB, which is the base metal ETF trading in the U.S., broke out and reached a new multi-month high on Friday. So I think it's time to wait and see on the precious metals, but it's time right now to get involved in the industrial metals.
It's absolutely, this is what's so fascinating about the markets in general, and they're so scintillating to see the different variables having an impact. And, of course, in Canada, I think there's more than one company that'd be very happy to think that we've bottomed out when you come to the base metals, the industrial metals, and are now ready for a leg up. The Canadian economy could certainly use it when we're sort of chugging along under 1.5% growth for the year. That'll be a very interesting comment for Canadians.
I'd throw in one more thing, too, that I forgot to mention earlier about Canada, because it's also kind of supports the bearish Canadian dollar theme, and that is the really interesting speech that your central bank governor, Paul Oz, made Monday, and talking about how growth in global trade will no longer kind of exceed global GDP growth to the same extent that it has in the past. And he says it's going to be more challenging for central banks, specifically in a place like Canada, where it's a commodity kind of based economy. And his quote was, "This will require more variability in exchange rates and interest rates. And a central bank that does not rely on a model that takes into account these things will be more, potentially impacted by external shocks." So to me, this was a clear case that suggests that the Bank of Canada is totally in play here. They're expanding their balance sheet. They easily could cut rates again now, given the CPI number we just got. And you get comments like that from your central bank governor, which basically says, we need to think outside the box in terms of kind of how we approach this on trade. That's really interesting to me. So I think the Canadian dollar is a really good candidate. And technically, you got very clear-cut breakdown levels here that were just tested last week.
Well, I'll tell you, it's going to be a fascinating going forward. There's, so much manipulation, but a great example there with the central bank take on things. As you say, Canadian dollar in play, Canada in play overall. Greg, we appreciate you sharing your insights with us, and thank you very much for contributing to our Inside Edge.
It's always my pleasure, Mike. You do a great job, and I'm happy to be part of it.
Great stuff with Greg Weldon. Go to weldononline.com, weldononline.com.